The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, the trend definitely is not the friend of the producer right now in these markets, as we saw more selling pressure on Wednesday in the soy complex, wheat, livestock as well. Corn was somewhat independent, although it was just kind of firm to steady on the day Wednesday. There's a lot going on here. Or to try to unpack it all, make sense of it. I know a lot of folks are asking questions right now. Joining us for market analysis, Mike Zuzolo with Global Commodity Analytics is with us here today. Mike, thanks for being with us. We were kind of chatting a little bit off air. It's a little tough to talk markets right now, and I know a lot of farmers and ranchers aren't overly happy to talk markets right now. It's just the bearishness in this grain and oilseed trade in particular, it has been tough to watch the last couple of days, Mike.
It has, and it's been tough ever since the acreage and stocks report. And, we put in that big down move as we got done with the month of June. And until we got the rains that came from Hurricane Beryl's remnants this week, we pretty much were treading water in everything. But the beans and the wheat especially had to really do some soul searching, technically speaking, on Wednesday's trade, Jesse. I think this goes to the point that I'll put out here in the very beginning of our program together. It really is about profit per acre. It's about revenue per acre, not just price per bushel. And what I mean by that is that I know farmers in northeastern Indiana, northwestern Ohio, even farmers in central Douglas County, Champaign County, Illinois, probably looking at 30, 40 bushel beans before the 1.5 to 2.5 inch rains came this past week. They're now back in the hunt for average, if not above average yields. And so while the market got hit, I think the revenue per acre and the profit per acre actually went up with these rains. And I think that's the tale to tell in the month of June and early July. And I think that's what we want to keep in mind and not bury our heads in the sand and look at only the futures market price. So having said that, keeping that in the back of our minds, two things I think are really important heading into Friday's WASDE report. And these kind of dovetail together with what happened on Wednesday's trade. The spreads are extremely important. We've seen the July no bean spread rocket higher after the acreage and stocks report, hitting almost 80 cents plus premium on a closing basis, July over November. That's a telltale sign of too tight of supplies or too strong of demand. Well, we can probably guess it's not too strong a demand because of what's happening with China and their soy imports out of the United States. Even though we had a small purchase on Wednesday, it was 24.25, not 23.24. And given their negative crush margins right now in some key provinces, I'm not real keyed up on China's soybean demand. So I think it's got to be a supply issue if we figure out a way to keep that front end premium as July expires on Friday, because July physically goes off the board the same day as the report here on Friday. August beans take over as lead month. So we were, I think, adjusting to that reality with July falling to the August, but it's still keeping a premium against November. So that's point number one. Point number two comes together with that and the rains that came in. Pork and bean trade really was active today. Wheat was as well because of thoughts that Russia's crops getting bigger as they harvest. But sticking with the Chinese mindset and the hogs and the soybeans, the inflation data that we saw from China on Tuesday night did not do any favors to the agriculture sector at all, because it really pointed to continued deflation. And I think that's where the WASDE report's got to come in and say, yeah, maybe we've got some issues with China's demand. Yeah, we got trade frictions with China and Russia, but what about the world supply? What's the world supply? We know U.S. supplies are pretty decent, but what are the world supplies, especially with the corn and the wheat?
I'm glad you brought that up and framed it that way. Let's talk about China a little bit here and some of this supply and demand. And as it stands right now, the trade is pretty comfortable with the U.S. supply situation. And so to that point, you look at demand. Well, demand's pretty ugly right now, for lack of a better term. And you mentioned that China sale on Wednesday morning was small for 24-25's marketing year. And we'll look at this chart looking at inflation in China. Let's talk about this a little bit more. I think this is a big piece, plus China going to South America more, et cetera, et cetera. So, I mean, that demand picture is really not great, and China's not helping, right, Mike?
Yeah, that's exactly right. And what we want to keep in mind here, because we're going to talk about this later when it comes to the corn and bean prices, is that 2014 through 2018 time period. That's what the trade's worried about. And in fact, I think that's what the trade is trading right now. And the algorithmic traders are seeing deflation in China. They're seeing weakness economically in Europe. And while the United States is still very strong, it too has tapered off in terms of some of the recent economic data. So you don't buy commodities in a deflationary mindset. You buy stocks. The dollar doesn't go down in deflationary time periods typically, it goes up. And I think that's what the market's signaling here as we hit the mid-year point of 2024. And that green box that I have highlighted in this chart where the China PPI year over year, the reddish pinkish colored line, that's where we stayed well deep in negative territory, 2, 4, 6% negative on PPI year over year during the 2014 through 2016 time period, and then crawled out of it very quickly by the time we got to 2017. If you contrast that red line then with what's happening right now, yeah, it still looks pretty tough because we're negative, but we're a long way away from this going down and making lower lows in the China PPI. We're actually making new highs in the China PPI coming off those 2023 lows. And so I look at this chart and say, okay, it doesn't give me a reason to buy commodities, but does it give me a reason to press the sell button so hard? And I think this goes back to what we've talked a lot about, Jesse. I don't think we'd be in the situation of a 2014, 2015 mindset in prices for the ags if it weren't for the negative relationship trade-wise with China and the United States. And it's really the bottom line point to me. And I think that's why, in part, the dollar remains so stout and so well underpinned as a safe haven.
Let's relate this Chinese inflation picture to soybeans and corn. And I'm thinking maybe it makes sense for us to stay with soybeans here for a second because China traditionally is a big U.S. soybean customer. Novi beans, I believe, made a new low Wednesday, 1067 at the close, if I'm not mistaken. And that's where a lot of this heavy selling has been the last couple of sessions. So looking at this November soy chart, weave this into the context of what you're just talking about with China, Mike.
Well, this is kind of what I do on a daily basis for the clients and subscribers, and you get a glimpse of it with the video people and the visual of it once a week. But what I really try and match together are the macro and micro fundamentals of what the trade's trading in ag. And like we saw in the 2009 time period with hard red wheat and how we were trading so closely with that time period before the end of May, before the beginning of June, we're now in a situation where we're trading almost just neck and neck and just point by point almost with 2014 November soybeans. And there's two big points to make here. You're right. We made a new low. Now I show the contract low on the November contract, at least on the electronic, at 1050 for November 24 beans, Jesse. But it still looks really rough because you're looking at fresh 2024 calendar year lows. So if I'm talking to clients and subscribers right now, and I'm addressing the WASDE report and saying to them, I really want the corn and the wheat to stand up and turn this market higher because global stocks are a lot tighter than we're acknowledging. Global corn stocks to use ratios heading into Friday's report are still at a 10-year low globally. It's the trade trading the US numbers. But I want that to become a reality for the rest of the trade, not just me. So when I talk to clients right now, I'm saying, look, I know it's low, but if you just got 40 bushels or 30 bushels to the acre yield bump because the rains came in at the right time, and you're still at this 1060 level, and in 2014, we didn't stop going lower, and we actually went down to the 901 level by the 1st of October, there's plenty of hedging to be done here and profit to be made on the table on a per acre basis. And that's why Friday's report is so critical. And the monthly lows from June, which were those acreage report lows, and a trend line right around the same area are so critical after Friday's WASDE report to me. I will make moves and recommendations, I think, for clients and subscribers. And I say I think for compliance reasons. I think I know what I'm going to do, but I think I'm going to make a move pretty dramatically if we can't hold the line here after Friday's numbers.
Well, of course, that risk of trading futures and options can always be substantial. Want to make sure we put that caveat in here as well. We're joined today by Mike Zuzolo from Global Commodity Analytics here on Market Talk. Mike, let's segue this conversation to December corn. I'll make this caveat statement here as well before we jump into this, and I'll let you kind of talk through this chart. But, with December corn, it's holding above 4 on the board right now. I'm concerned if it breaks below 4, what does that look like? And what does that do to farmer sentiment in particular? Your thoughts, Mike, as we talk December corn right now, and what your feeling is on that side of the ledger, Mike.
Yeah, I'm just as nervous as you are because the producer is very frustrated right now. And that's why we're talking together today about this. But the December corn chart here is a little busier because I've added several more years that I think we should be trading more like 2015, like 2023 last year, which is the yellow price action. But instead, like the soybeans, we've taken the route of 2014. And I will go right back and reiterate that's because of China for the most part, the strong dollar and the trade relationship. So we can't ignore the fact that we're trading like 2014. We're looking for a reason, fundamentally, like we were looking for a reason back in the acreage and stocks report, to change the mindset of the trade from weak demand to low supply or tight supplies. If we don't do that, like the soybeans in 2014, the December corn went down to an October 1 low, I show of about 318. So that's almost 80 cents, 85 cents away, almost getting closer to $1 away from where we closed on Wednesday's price action. And notice what the corn did on Wednesday's price action. Unlike the July beans, the July corn actually gained premium against the September and the December. And there's something going on there we've got to figure out, just like there's something going on as to why Paris corn is $1.90 premium to the CME market. We're trading $5.90 futures in Paris on the corn board of trade at the Matif right now, Jesse. And I think that's the world price, but we're so laser focused on the U.S. price. If that doesn't come to fruition and the trade doesn't see that, Friday, with a lower Brazilian corn crop, a tighter Ukrainian corn crop mixed in with our bigger U.S. corn crop, then I'm going to have to say obey the technicals and recommend getting defense, because like 2014 beans, 2014 corn kept going lower into the harvest time period.
Well, of course, one day doesn't make a trend. This is a couple days in a row, though. Now we've seen some of these bearish trends in grains. Be interesting to see how we close the week and what those new WASDE numbers show us for sure. I'm also concerned in cattle now, and I've wondered this, and I wanted to ask you, and I'll pull this chart up too on our video feed, the negotiated cash here. Some folks have been muttering maybe there's a top in this cattle market. Seasonality could be at play here. We've seen a couple days in a row with some fairly hefty drops. What's your feeling in the cattle trade this week, Mike?
I am exactly where I have been, essentially, Jesse, where I have been nervous after July 4th that we needed to feed the bull with the feeder cattle especially. And it was important especially to note that the feeder cattle could not go higher when the corn was making new lows after the acreage and stocks report. That could be an early warning indicator that the funds are done buying feeders, because they realize what you're talking about, that seasonality after the July 4th holiday. I think in this chart right here, going back to the fat cattle, going back to that negotiated cash, we went from a 193 plus level down to 188.30 on Wednesday's trade. That came out at mid-session. That kind of sealed the deal for the losses to be locked in on the day when it came to the fats and the feeders clearly leading the market lower still. But having said that, you still have a $6 premium in negotiated cash right now against the August fat cattle, and you've got some real heat coming into the major feedlot areas of the southern plains. And so I'm not nearly as negative the fat cattle market and not nearly as worried about hedging the fat cattle market and taking more of my risk in the cash market for the next 20 days. as I am the feeder cattle market, because that feeder cattle market has a lot of risk to the downside, technically speaking, more than I think than the fat cattle market does. And so that's kind of how I'd shape things up. I would say, like the grains, we get big numbers on Friday in the WASDE report, a lot of export, import, production, and price data in the meats, just like we do in the grains. It's just as important today for the livestock in terms of holding the technical lines here for the funds as it is for the grain markets.
Well, and with cattle too, it feels like a lot of this volatility has been in futures and it hasn't translated to the sale barn yet. It hasn't translated to the auction market, things like that. So I wonder, if that starts to happen here in the next couple of weeks, is that the other shoe that needs to drop here in cattle, Mike?
I think that's exactly right. And, like you just said a minute ago, one day doesn't make a trend. Now, if we saw negotiated cash drop below 185 or 184 area, that would concern me that we are making a top in the summertime, because we are seeing consumption fall back. And we've talked about this. Retail consumption's getting wobbly. I read an article, I think Argentina's beef consumption domestically, it's going to be the lowest in 110 years in that country because of prices. Our Jan to May beef exports on a volume basis down 5% from the same period in 2023. Why? Because Asia's not buying as much because of that strong dollar and that near 40-year low in the Japanese yen. These things matter to the funds and they matter to the fundamentals. And so we do need to keep that negotiated cash price strong. And I think then you can find a reason to think that you could do more marketing in the cash instead of having to jump into the future side of the equation.
Let's talk hogs as well. And you mentioned earlier in the show that pork and bean trade working on Wednesday. Just looking at this lean hog market in particular, more triple-digit losses. The bleeding just doesn't seem to want to stop. We're looking at a pork cutout chart here on the video feed. I mean, talk to me about hogs. What exactly is going on? I think a lot of hog producers are waiting to see where this bottom comes into futures here, Mike.
Yeah, and this is an important time for the hogs as well, because the July contract is getting ready to go off the board in the not too distant future, and the hog index, the cash index, is right there with the July future. So July's got theoretical support from the CME cash index, but that CME cash index needs support from the overall pork cutout. And that's the purple line on this chart, trading at 95, 93 area. That was not what we wanted to see coming out of July 4th. We need it back above 100, and we need it heading back higher. And the reason I did this chart today for you, Jesse, is because we talk a lot about the BLT seasonal, the bacon, lettuce, tomato seasonal, that time period where tomatoes come on and the restaurants and the grocery stores start to feature a lot more bacon. You can see this in the belly cutout, and this is why I came up with this seasonal, is because in the last few years, you can see a pretty definitive normalized pattern where you get to the 1st of July, you start to see that green line, that belly cutout start to spike and go higher for a very brief period of time, about a month, month and a half. And that's what we need to see kick in here, right now. And then I think we can get support from the overall cutout market. And that justifies the idea that hogs in July and August at 88 are more right than October hogs all the way down underneath 70. That's the debate in this market right now, is you've already got the discount in the back end. Do you need to push it all the way into the front end now because you don't have the demand side? So very important time period for the hogs as well.
Mike, great thoughts as we wrap up today's show. What do you want producers to keep in mind here across the board as we're watching this bearishness in these markets? What would you say to folks today?
The thing is that statistics and the numbers don't lie. Our exports in corn are up 30% year to date right now, and we're getting into the last part of the marketing year of 23-24. Our world stocks to use numbers are the tightest in 10 years at a little over 25%. Those numbers aren't made up. Those are real numbers. And Paris corn is $1.90 over the CME for a reason. We just don't know why. And I think that's what we really want to focus on in terms of the marketing. My personal belief is take the hedge on the beans if we can't get any kind of support off the corn and wheat after Friday. Move on that almost immediately. Lock in your profit because you've got yield now, and then look at the corn and wheat maybe next week. That's kind of what I'm looking at right now, but I want to really obey those technicals at this time of the year, Jesse.
Mike, if folks want to take a look at your analysis, reach out for a conversation, how can they get in touch with you?
Yeah, globalcomresearch.com is the best place. Globalcom with 2 M's, research.com.
With that, Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, sir. Thanks for joining us. We'll talk to you again next week.
Thanks for having me, Jesse. You have a great week too.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.